The leader of the UK's Railway Drivers Union has issued a massive warning about this summer's transport havoc as his members vote for the first nationwide strike since 1995. Walkouts over compensation are expected to exacerbate the situation. The TSSA, which represents employees at stations and ticket offices, and ASLEF, which represents drivers, are both voting on strike action, and these come after the RMT strike from last month. For more on these headlines, cross over to London. We're joined by international financial analyst Opeoluwa Dapo Thomas. Ope, good morning to you. Starting with the U.S., can we draw any inference from Janet Yellen and Liu He and their talks? Any encouraging signs as far as U.S.-China relations?
Oh, yes, it's very encouraging. Despite the fact that both countries are adversaries, they have to ensure that they're on the same page to economically, even if they are on different paths geopolitically. Because the truth is that both countries are very, very big and dominant countries in the world economy. So anything that happens in any of those countries would have a spillover and a ripple effect on the global larger economy. Let's take, for example, when the coronavirus happened 2 years ago, it came out from mainland China. So you can see how the Chinese businesses were shutting down and how it spilled over to the global economy, how it spilled over to American economy, and that's where everyone started shutting down their borders. I mean, the first sign of when the markets went down was when Apple decided to close all their stores in China. That's when everyone took it serious. So these countries are too big, they're too heavy in the whole global economy, and they have to be on the same page. Anytime China wants to adjust their market rates or their interest rates, they look over to what goes on in the United States, what goes on in the Federal Reserve. They want to see how their own interest rates are tilting. They have to be on the same page economically because of how interwoven their network is in the global economy. So despite the fact that sometimes geopolitically they do not seem to agree, and despite the fact there are sanctions and there are issues with trade reliefs and trade tariffs, they have to always be on the same page. And this talk is very, very encouraging, and it shows that they are ready to ensure that despite their issues, they are on one single page when it comes to economics.
All right, another set of folks that seem to be on the same page is the unions in the UK. We seem to be talking about strikes all the time. What's the impact of this move from the train drivers union?
It's going to impact travel. I mean, it was quite difficult traveling the other week when I tried to move. It's very, very, very. It's a sad situation. I mean, it's the first time they're having any sort of a national strike since in 1995, if I'm correct. It's very, very difficult, and basically they just want higher wage rises or higher wage pay, and you can't blame them because obviously inflation is eating into their take-home salary. So they want a wage rise. They are very, very functional to the UK economy. The railway is very important to the UK as a whole, apart from the economy, in terms of hospitality, tourism, trading, and every single thing. So they feel they have not been given their fair share for the type of services that they deliver to the economy. And basically, this strike would offset a lot of things. And then it will affect a lot of businesses, because obviously employees will not be able to get to work. People live far away from London. So, for example, someone coming in all the way from Milton Keynes or someone coming away from Birmingham will not be able to reach his destination, and that would obviously impose on the productivity of a company. So these things, like I said, are interconnected, and obviously they have a ripple effect. So it's a very, very drastic situation, and I hope the government also interferes in it.
Speaking of government interference, since you mentioned it, Europe, Germany, the move for the government to take stakes in struggling gas importers. Well, what do you make of that?
Well, it's interesting because usually people always advise government not to interfere in business, but I usually believe that there has to be some sort of overarching interference, because the truth is now we have large cost of natural gas. Natural gas is one of the hottest commodities in the global economy as it is today, and now the cost of gas is rising, and most of these companies that procure it from the spot market cannot sustain the cost, and so it's making most of them bankrupt because it's affected their business model. The costs are so high, and obviously they don't want to also transfer that cost to the consumers. But that's what this law makes. Now, this law is going to ensure that these costs are also going to be transferred to the consumers, which technically will make life difficult for the Germans. So the government coming in to step in and saying, okay, any company that dies or any company that, has bankruptcy issues, they would step in and intervene with money. And this is also targeted at Uniper, which obviously helps in the procurement of gas from Russia. Obviously, the high costs are affecting their model and their modus operandi. So the government, obviously, of Germany is saying that we will interfere and will ensure that everyone is sustainable.
Real quick, India, this record $33 billion of outflows from foreign investors in the Indian markets. Does this worry you as far as emerging market equities are concerned?
Oh, yes, it's very worrying. And to be honest, a lot of people are dumping risky assets, and this dump has been since October. So in June, there was a dump of $6.5 billion from the Indian market, and it's been dumping for the last 9 months. Fund managers are looking at net selling, and we don't know when it's going to stop because interest rates keep rising, and obviously the global economy is in a mess right now. So the truth is that with this dump, it's not a good it's not a good more like call it sign for the economy. It's not a good sign for the Indian economy and emerging markets. Now, people who want to invest in these countries and put a lot of inflow, it will affect the FDI cost, it will affect capital cost and everything. So it's a very, very terrible situation we are in the stock market. Almost $3 billion has been wiped out. That's about 1% of the Indian market's capitalization. So how do investors now position themselves in the next few months, especially as gloom doesn't seem to go away? We're expecting more interest rate hikes. We're expecting more commodity super cycles. We're expecting more high price of cost. So it's with a possible recession, we should expect more what I call it dumping from foreign investors.
Very volatile times that we are in. Opeoluwa Dapo Thomas, International Financial Analyst. Thank you so much for joining us. Appreciate your time.